Welcome back to episode 7 of Compound Growth. We are your hosts, Brody Simmons, Mike Voynick, and a lot has happened since our last episode. We kind of touched on Iran a little bit in the last episode, but we kind of want to get into those details a little bit more as that has really kind of unraveled and talk about how that's affecting the economy, the U.S., and get into, oil prices, things like that, along with the Fed meeting. So let's jump into it.
Yeah, thank you for joining us. So, Brody, what are the current updates with the Iran war?
Yeah, so this war officially began February 28th as the U.S. and Israel started joint attacks on Iran. So in retaliation, Iran has started bombing the oil infrastructure of other Gulf nations, as well as tightening down on the Strait of Hormuz, which has provided some geographical conflict across the world. So Iran is choking out the Strait of Hormuz. And I mean, what is the Strait of Hormuz? That is where a lot of these Middle Eastern countries use their ships to facilitate the movement of oil. It provides 20% of the oil for the world, for the globe. So being that this is being compacted and choked out, is providing, lower demand across all nations.
What is causing the choking out of the Strait of Hormuz?
So yeah, Iran is making it tough for ships and just unstable for ships to actually be shipping their oil supplies through the strait. So that's what's kind of causing this conflict of there are 5 ships per day going through. So in addition to choking out the Strait of Hormuz, Iran is bombing their neighbors, Saudi, Qatar, and the UAE, and they're focusing on their oil infrastructure, these facilities that they are using to produce their oil. So there's 2 constrictions on the overall demand of oil. Now, the United States does not buy their oil from Iran, but we do purchase oil from their neighboring countries. So it is affecting the U.S. We're seeing this across the globe. If you're going to the gas station, you've already seen these price hikes already factored in. So, Mike, based on these events, how is this affecting U.S. markets? Why should we care about this?
Yeah, it's affecting our markets quite a bit. I'm sure many people have seen in the news the oil shock this week. Crude oil has been extremely volatile in the recent weeks because of these events. The price per barrel, as of this morning, was up to around $115 per barrel. So crude oil creates a lot of products that we use. So you'll see this at the gas pump, like Brody mentioned, but it's also affecting airfare. So if you're traveling, you'll see prices increase there. Crude oil is used to make all plastic products and packaging. So if you can imagine, everything that you buy is increasing in price because we package everything in plastic. Food imports are also increasing as well. If you think of anything that the United States and other countries import or export for that matter, it takes oil to do those things. So when the price of oil increases, everything else in our supply chain increases.
Yeah, we're not just seeing it at the gas pumps. It's going to have a trickle down effect. That's where it starts. But, over the upcoming months, I think we're going to see, continued increasing pricing across the board.
Yeah, so energy prices increasing tends to slow everything down and increase the price of everything. Oil prices actually feed directly into headline CPI, which is the Consumer Price Index, and that's one of the main barometers of inflation, which will bring us into the Federal Reserve meeting that occurred yesterday on March 18th. So, Brody, what were the main highlights of that?
Yep. Yeah, so at the Fed's meeting, on March 17th. A few of the main points that came out of that is that the Fed is holding rates steady. So their target rate is still between 3.5% and 3.75%. And I think everybody pretty much expected that. Now, the key driver here from market reactions out of this Fed meeting is expectations. So I think before this meeting, people were expecting a few rate cuts this year. But now after seeing the dot plot, if you don't know what that is, each member of the market committee does their dot that represents where they expect interest rates to be by the end of the year. And based on that dot plot, we are now expecting one rate cut through the end of this year. So a couple other points that we got out of this meeting is that inflation came in higher than expected. Again, the Fed's target inflation rate is 2%. We're sitting at about 2.7%. 6 years later, we're still above the Fed's target rate. And on the other hand, the jobs report for February came back lower than expected. So these are two things that are kind of pulling the Fed in two different directions, where yes, the jobs report came back negative, so they want to lower rates in that aspect, but inflation came in higher than expected. So if the Fed were to lower rates too fast or too much, then inflation kicks back up. So even the Fed isn't sure what the next move is going to be. The market is, volatile as it's been pretty much this whole year. Inflation's still high, jobs are down, so they're being torn in two different directions here. One member voted to cut rates while the rest voted to hold steady. So even the Fed is torn even between themselves on what they should be doing.
Yeah, and we know that when there's a slowing economy, a poor job market with high inflation, it's a curse word sometimes, but we're tiptoeing the line of stagflation right now. Yeah, following the Federal Reserve meeting, we saw the overall market pull back a little over 1%. So market didn't react very well to the meeting for good reason.
And I would say that's not because of the Fed not cutting rates. Everybody kind of expected the Fed not to cut rates
Right.
in this meeting, but it's because of expectations moving forward. It's the expectation that up to this point, people were expecting multiple cuts this year. And now, based on the dot plot, based on, what Powell is saying, they're looking at more like one rate cut in the fall or winter of this year.
Yeah, it's less about the numbers because most everyone knew the numbers already. It's more about the guidance that the chairman is giving and his personal outlook. I think people expected him to be a little bit more bullish on the overall economy. So at this point, the war in Iran is factoring in a big way to the Federal Reserve's decision making. And when we have oil running up and up every day, now, like we said, up to $115 a barrel, people are less interested in buying the speculative tech stocks or buying the semiconductor industry with these hyperscalers when they can just buy oil and increase in their portfolio every day. So with oil and real assets running up every day because of this war, the tech sector has remained pretty flat and seeing some losses along the way as well.
Yeah, I mean, across the Magnificent Seven that we've seen just fuel the S&P 500 over the last couple of years, all of those stocks are negative year to date and are not handling the volatility very well that is going on right now.
Yeah, so in an environment like this, we've seen, and we've said this about broadening out your portfolio. Where do you invest your money when tech is looking to be flat for the first quarter and potentially moving into the rest of the year as well? Well, it's going to be quality and real assets. What are real assets? Real estate, commodities, agriculture, and infrastructure, real physical things that you could get your hands on and see in everyday life. And what are quality stocks? Well, these are companies who have low debt, low price to earnings ratios, high return on equity, and they're paying out dividends. That's how you can get some extra yield in your portfolio while these companies remain flat.
Yeah, and I feel like at this point, if you've heard the term K-shaped economy, I feel like that's what we're seeing, where these investors, these individuals that have real assets, that do have funds, wealthier individuals usually, are increasing their net worth through real assets. But then those individuals that don't have real assets are decreasing in their overall net worth, hence the K shape. So I feel like that's kind of what we're seeing right now, that's tied to exactly your point here of holding real assets.
Yeah, you've probably heard that term thrown around quite a bit, the K-shaped economy. Well, that just means in the exact same market environment, the people who already own the real assets are increasing in value, and the people who don't own those real assets are decreasing every day because inflation is eating away at their cash. It's eating away at their real wages that they're earning.
Yeah. And it's as sad as it may be, it's the wealthy getting wealthier and the poor getting poorer, kind of limiting the middle class. So with all this volatility, it's not all negatives. And I feel like that's been the word that we keep coming back to on our podcast is volatility. But with all of this that's been going on, we see that as a great opportunity where you can buy in at a discount. There's, stocks that are being negatively affected by this. But, it's just a matter of investing over time. So we see this as a good opportunity to get in at a discount.
Yeah, and with this volatility, it's extremely hard to predict when the companies are going to be at a discount. One day they're up, one day they're down. One day we drop bombs, the next day we don't. So dollar cost averaging is going to be your best friend here because you don't have a crystal ball. Buying in as frequently as possible for you is going to give you that compounding effect.
And one thing that a lot of people don't even realize is that if you're putting money into your 401k, well, that's coming out of each paycheck. Most people are getting paid bi-weekly. Well, guess what? You're already dollar cost averaging in that sense. So you're off to a good start if you're doing that.
Well, guys, we always want to bring you the latest updates in the market and how that's going to affect your portfolios. So, talked a little bit about the development of the Iran war and how that's creating a shock in energy markets. And we gave you the latest updates on the Federal Reserve meeting. So, we appreciate all the support and hearing from us.
Yep. Thanks for joining. We'll see you in the next one.